Welcome back to the Investing Markets and Money podcast from the Armchair Trader. Joining us on the show today, we are very lucky to have Thomas Moore, who's Senior Investment Director at abrdn Asset Management. Welcome to the show, Thomas.
Good to speak, Stuart.
First off, I thought it'd be good to just give listeners an idea of what the investment trust itself does in terms of its core strategy, what its investment objectives are.
Yeah, let's do that. So the investment objective focuses on three key areas. So let's go through them one by one. First one is an above average yield, and we are doing that in spades at the moment. So we're finding lots of higher yielding stocks, and the yield on our investment trust is typically somewhere in the high sixes or low sevens, currently about 7%. So that's the first part of the objective. Second part of the objective is a growing stream of dividends. So we are doing that as well. We've got a 24-year track record. We're coming up to a 24-year track record of dividend per share growth. So that is the second part. And then the third part is real growth in capital. Now, we can come on to talk about this. We believe that by being index agnostic, which is really ignoring the market cap and saying, actually, where are the best opportunities, that's going to give us the best opportunity to grow capital over time. That hasn't been true for the last 3 years or so. And the reason for that is this multitude of different macro events. And so it's been having an index agnostic approach, being open-minded about all the opportunities down in the small caps and the mid caps has actually been a bit of a handbrake on performance. But we think that's the opportunity right now. So there's lots of stocks we're finding in that area of the market that have been completely disregarded. So that's the three parts of the investment objective.
I mean, yes, that's a theme I've been hearing from some other fund managers. Just we don't seem to be able to catch a break in terms of those macroeconomic events. We don't seem to have a period where people can just get on with quietly managing money without some further disruption coming down the way. When you're talking there about the capital growth for the fund versus the yield, where does the emphasis sit for you? Is it more the yield you're going after when you're looking at stocks, or is it a balance between the two?
My view is that there shouldn't be some sort of conflict between those two. Now, you can argue that in any given year there can be a conflict between them. So let's give an example. We've been living through this period of intense optimism towards any stocks that have structural growth. And the Mag 7, the Magnificent Seven, are the most striking example globally of that. And those stocks obviously yield pretty much nothing. I mean, a couple of them will be paying % or two. But in the UK, we also have been living through a sort of relatively sparse period for yield stocks because people have preferred stocks with what they believe is structural growth. So the stocks I'm talking about, things like Experian, the data provider, and also Relex, another media stock. And then you've got companies like LSE and Sage, which are in that group. Now, they're not quite Mag 7, but that's been where investors have been shifting over a relatively long period of time. So that's been a more difficult backdrop, but we see that as potentially changing now, and I'll explain why as we go through the next few minutes. I think it's an interesting area to focus on because I think 2024 has been a much better year for value stocks, and so if value is performing better versus growth, then suddenly that question you asked really comes into its own for us because we're able to find stocks where you've got yields which are ridiculously high in the sense that these companies are going to carry on paying those dividends. We've done the work on these stocks. We believe there are lots of stocks with yields that are going to compress. And there'll be this breathing out moment when people look at these stocks and they say, well, actually, that company can carry on paying the dividend and it's yielding 6, 7, 8, sometimes even 9 or 10. And it's by actually having the confidence to say, we've done the work, we know the stocks, we believe these companies are safe, and therefore the dividends can be paid, and therefore the yields can compress. And you'll get capital growth at the same time as dividends from those companies if we're right. And we believe we're showing this year that thesis is now coming through.
And looking at UK equities, the overall UK equity market, would you say compared to other big stock markets overseas that the UK is looking fundamentally undervalued at the moment? And if so, why is that?
That's a really interesting one. I mean, we do look at valuations across different markets for the same sectors, and I think that if you do that, if you do a sector neutral version of the UK and you compare it to the sector neutral version of other markets, I mean, the most striking example is the US market. But apart from markets like Italy, where you could argue there's even more of a structural problem perception than there is here in the UK. You know, there are few markets like that. Some of the emerging markets are cheaper than the UK, but it really is that extreme that you look at, you know, a beverage company and it's 4 or 5 multiple points more expensive in other markets than it is in the UK, and you can do that across all these different sectors. And so I think that's quite encouraging because that suggests that people, in their wisdom, or perhaps not in their wisdom, are saying, "Well, we won't allocate to the UK." But you find that actually the UK is full of perfectly good companies. They trade globally, so they're not even dependent on the UK economy as much as people might think. And people have just said, "Well, we're not allocating to the UK." And that's causing, and you see that in the data actually, the net outflows from UK equities have been persistent now virtually every year since Brexit. I think there was a tick up in 2021. I had a look at it last night actually. I think 2021 there was a sort of recovery trade on, which was buying the losing market, and that was when the vaccines were found, if you remember, and there was a sort of value trade. But it only lasted about 6 or 9 months, then it petered out again. So and that's the really key question at the moment. It's what is the catalyst, and I think we can come on and talk about that. We've been waiting for that catalyst, but we've had this series of macro variables going the wrong way, and in the end, we just believe value will come out. But finishing off this point, M&A is a big way to resolve this because I mean, in our portfolio, in the last 12 months, we've had 4 successful bids. We've had a couple that have happened and then the bidders walked away. But so we had 6 really, but 4 of them actually consummated with an actual takeover. So we had DS Smith, which is a paper company bought by International Paper rather. Now International Paper, it's just a more expensive stock. It's more highly valued. So they're able to use their expensive shares to buy DS Smith's cheap shares. Centamin, similarly, an Egyptian gold company, was bought by Anglo Gold, which is a US listed South African gold miner. Again, in broad terms, 2 times NAV for the US listed stock, less than 1 times NAV for the UK listed stock. So that's pretty good. Timon, AIM listed windows and doors business. That been in the portfolio for years, and I've been scratching my head. Why is that on 10 times earnings, yielding nearly 6%? That makes no sense for the world's leading windows and doors business. So that got bid for by a US business called Quanex. So those were 3, and then we had Hargreaves Lansdown, which was a PE consortium. So these things do happen, and I think that value question, if we get more M&A, that's the way to resolve it. But in the meantime, we're waiting for this macro to turn.
And I was looking at the sector breakdown. You mentioned sectors earlier on. Looking at the sector breakdown of the Equity Income Trust, has got quite a strong weighting in the financial sector. Um, correct me if I'm wrong, but it's like close to half. Why is that?
Yes. So these are conviction holdings, and if I give you the backdrop, it's about 39-40% at the moment. So you're not far off there with that estimate. And the sector is a broad sector. So there are big banks who are making hay at the moment because, of course, we can talk about this later. But one of the effects of the UK budget and Donald Trump's election is that people have started to eliminate the prospect of multiple rate cuts. Now, of course, if you're a bank sitting on people's deposits, that's free money. So that's money that these banks are making, but we're sitting on our deposits and current accounts and so on. So that's great, and they invest that in gilts for 3 to 5 years typically. And those gilt yields have gone up, so they're actually not even just generating the overnight rate; they're generating quite a sizable gilt yield at the moment on that money. So that's one example. But then we've got financial services companies, which includes wealth managers and brokers and so on. We've got other sectors as well within this, lenders. So you look at across the board, and actually the exchanges and so on, and there's actually quite a broad range of different sectors. Now, quickly on this one, within the UK equity market, you've got to look at the weightings according to the different indices. So you've got FTSE 100, where banks are a big sector, but nothing like that scale. But if you look at the FTSE 250, it's very, very different. Financials are really quite dominant. That's by far the biggest sector in the FTSE 250. So again, it goes back slightly to the index agnostic point as well, that we really want 8% in AstraZeneca as an example, and that's what Astra got to at £130. It was about 8% of the index. Now our view is we actually sold our AstraZeneca at that point. We sold out completely because it's yielding less than 2. It's a good business long term, but it just got a bit frothy, and so our view is actually that we're not going to be slaves to this thing called the index. We want to own stocks that we actually want to own, rather than because they're big in the index. And the result of that will be we will have some pretty big bets in some sectors and not so big bets in other sectors.
And I guess that's what people are coming to an active manager for, aren't they? They don't really want to own they don't want you to own the index for them, because they can do that with an index tracker at the end of the day. They want to see some active management, some actual skill there.
That's my view, and I think that's our view at Aberdeen. We're of the mind that actually, we're in a very competitive marketplace, and we've got to prove ourselves. We've got to prove that there's some differentiation, and that we're delivering something which is an outcome. And in this case, the outcome is very, very clearly the yield. The capital growth element of the outcome is the bit that we want to prove out in the year ahead. Now, it's been a much better 12-month period for the investment trust, but that if we do both, we believe you can really help to drive some interest in the trust, and that will help to reduce the discount to NAV, which is currently about 4% or thereabouts.
Well, that's actually quite a small discount when you compare it to a lot of the trusts in the market, so that's pretty good. Going back to what you were saying about AstraZeneca, what's the kind of maximum percentage holding you have for any one name in the portfolio?
Yeah, it's just over 5%. My basic question I think all of us as investors can ask any time is, if we were starting a portfolio from scratch, so let's say something's outperformed, and I'll give you an example. I mean, Imperial Brands is done really well. So it's a very successful, well-run business. That's now just gone above 5%. And so in our internal meetings, when I meet with my colleagues and we discuss how big do you think these positions should be, one of the questions we always ask each other, and we sort of challenge each other, is, if it goes to 6, would you really start a position at 6%? So we tend to try to at that point, when it goes through 5, really just let's be clinical about this, and perhaps take some money out and put it to work somewhere else.
So talking now about some of the catalysts which we touched on earlier on, obviously election for the UK in July, change of government under new management. What's your view on that? Do you see that as positive for UK equities and for your trust?
I think, to answer this question properly, let's go back to what came before. Now, we had a pretty disappointing setup in the past 5 years. I mean, we had COVID, which caused government debt to blow out. So we had this huge credit card bill that needed to be paid off, and gilt yields, quite understandably, have blown out in the last 5 years, because people have looked at the sheer size of the government debt, and they've put that against GDP and seen it's gone through 100% now, and that's uncomfortable. So I think that's the backdrop, and that was the genesis of the issues with the trust budget in 2022. And then, of course, all the changes in prime ministers that we had during that term did cause quite a lot of instability. And if you're looking at that from afar, you would be forgiven for questioning whether the UK has actually got a particularly strong political governance situation. So the first point to make would be a clear majority is a step change from what we've had before, where everything felt pretty shaky. But I think the follow-up question is, what are they going to do with that big majority? And the jury is very much out on that question. The pound is holding in there, so as you know, it's sort of high 120s, having touched 130 against the dollar. So it's the pound doesn't perhaps tell the full story. We've got gilt yields that are going up, and why are they going up? Well, the UK budget was pretty aggressive, both on tax rises, but also on borrowing. So the jury is out. Now, having said all of that, that's hitting UK domestic stocks at the moment because perhaps the jury is out is a polite way of putting it. Actually, people are looking at this and saying they're not convinced GDP growth is going to come through from this budget. And if GDP growth fails to come through, tax receipts will be weaker than expected. And guess what? Next October, when Rachel Reeves stands up, she may have to do more tax rises if tax receipts disappoint. So that's the domestic situation. But as I said before, right across the UK market, there are stocks which are cheaply valued with access to lots of different markets, including the UK. I would love to sit here today and say to you, we are confident about the prospects for the domestic economy. Hand on heart, it's harder, I would say, given the gilt yields move that we've seen in the last few weeks post the budget, to say that you can put your finger on the catalyst for a sharp uptick in UK GDP growth. However, that's been the case for years, and so actually we've got currently more of the same. So let's see how they do. It's early days, but the UK market is cheap for that reason anyway.
And when you see something like the budget, last month's budget coming out, as a fund manager, does that affect your decision making in terms of the stocks you're picking? Do you sort of think, okay, we better start looking more defensively at some of our positions, or are you agnostic when it comes to that?
Like, I think the answer to that question is, where do we think we can add value? Now we meet companies, we do the analysis, and typically those decisions we come to are going to be borne out by the evidence over a 1, 3, sometimes even 5 year time period. The facts over that emerge during that sort of 3 year period, let's say on average. But having said that, you get these moments when macro changes happen, and I think two of them that have happened recently are giving us some guidance on where things could land, not just on a 1 week view or 1 month view or even 1 year view. But I think the UK budget and Trump's election in the US have provided some pretty clear signals. And whilst macro is an input and it's not the key input, the company specifics are the key input, I do think these two events have really the potential to change perceptions. And I think in the case of Rachel Reeves' budget, I think she's got some work to do now, because the perception is that she thinks that the private sector is on tap. It's sort of tax receipts can just continue from these companies, add a bit more on the national insurance, add a bit more to whichever cohort. And typically she's going after companies rather than individuals. But in the end, it will feed back to individuals, because either your wages don't go up as much if the company's paying more for you to employ you, or it gets fed back to individuals in terms of higher prices. Sainsbury's mentioned, I think it was 130 million, Marks and Spencer's 140, I think it was. These are big numbers. They're coming back in some form to the consumer or to the employee. So I think that is a negative for some of those companies. And then secondly, on the Trump election, I thought it's worth mentioning this because really you've got a pro-market president, and he's surrounded by people like Elon Musk who have done their stuff already at Twitter, and you can see the impact he could have on government efficiency. Now, that's likely to be positive for US corporates, US economic growth, as long as it doesn't get out of hand and there's some kind of massive boom which turns into a bust. But those two events side by side have focused minds, I think. So I can see short term why the dollar's perking up a bit versus the pound. And so to be aware of that, I think is important. So can I find cheap stocks which have got some exposure to the US, which is set for a potentially quite a golden period, if these guys do the right thing on their policies, deregulation, tax cuts, and so on in the States? Yes, I can. I can find names, and I'll give you one. That's quite a simple one, really. Balfour Beatty. Balfour Beatty is a company that has about 50% of its revenues coming from the US. It's on about 10 times earnings, and it's got about half its market cap in cash. So these companies, if they play their cards right and win contracts, and this one's just they've just won a contract in Austin, in Texas. So there are some big opportunities for UK companies trading on really low multiples. So I think that's what I'm doing at the moment, thinking about how I can make sure I've got sufficient exposure to a positive economy with a positive growth outlook like the US.
And sort of looking at some potentially good news, UK inflation is dropping, and Bank of England has been cutting rates. As a sort of yield, a manager with a strong focus on yield, presumably that's good news for you guys because you're offering investors an alternative to those high interest rates that were prevailing previously.
I think it's a good point, Stuart, because I actually, when you look at the period I mentioned earlier when people were going for these out and out growth stocks, I mean, actually, you know what? It started before COVID. The period in which I think a lot of income managers were really scratching their heads was 2018 and 2019, because in those 2 years, um, if you have a look at, I don't know if you ever look at style indices, but if you type in MSCI growth index and you look at the UK growth index and then you compare that with the MSCI UK value index, you'll see that the really painful bit for cheap stocks, yield stocks, etc., was actually that bit pre-COVID. Then, of course, COVID happened, and then, of course, the stocks that got really slammed by that were the cash generative companies that are typically value stocks as well, because they all had to stop selling things or doing things or sort of shutting things down and laying people off and cutting their dividends and so on. So you had this quite extended period in which growth was outperforming value. And that was when interest rates were very, very low. And if you just think about it simply, the discounted cash flows, it sounds very complicated, but really what it is, you're saying that companies where you've got high conviction in growth get rewarded disproportionately by low falling interest rates, because that £100 or $100 that you're sure you're going to be earning in 10 years' time gets discounted back at a tiny little interest rate of whatever you believe it that the rate should be. Let's say it's when rates were 0.1, it was extremely low. Now it's not so low, it's gone up, and of course mathematically that has a really big impact on how you value growth companies. Whereas the companies that I own are typically companies where I actually believe they do have a good long-term opportunity, but they're also being valued as if they don't. So these are companies where people are saying, well, I'll take my cash flow to this year and next year and the year after, and actually I'm not sure I'm going to price much in for the subsequent 7 years. So really, if I just get lots of cash in the next 3 years, I'm pretty happy, and anything else is icing on the cake. And those companies tend to perform much better when interest rates are higher.
Looking at the stocks themselves, I mean, if we talk about the ideal stock for the equity income portfolio, the stock that you would like to have in your stocking on Christmas Day, I mean, what does that look like? What sort of characteristics do you look for?
It's a good question. I've described that stock as a nirvana stock, because I want a stock that's got some yield. I don't tend to buy anything with a yield of less than 2. And I mentioned AstraZeneca earlier. When its yield went below 2, actually, I was sort of, again, you go back to the question: would I buy it from scratch? And the answer is no. So something with yield, typically in excess of 2.5%. And by the way, if it's that low, I want it to have growth. I'm not going to buy a stock with 2.5% with no growth. So that's important. The next bit I would say would be the dividend growth. So what are the prospects for that company, and let's what's the market backdrop like for that company? Are they seeing consolidation in their sector so that they can all price a bit more and increase their operating margins and so on? That will help them to grow. It doesn't mean they have to be growth stocks, if you see what I mean. Growth stock sounds like it's what a Mag 7 sort of super duper, off to the moon stocks. It doesn't need to be one of those, but it can be a stock with specific drivers that will allow it to grow for the next 3 to 5 years. So that's the second bit. The third bit is, what's the change that can happen to a company that will allow the valuation to re-rate? And let's keep it simple. Let's say instead of PE going up, let's actually just say the flip side of that is earnings yield goes down. So if you flip P over E to E over P, you've got the earnings yield. And then, dividend yield is a function of the earnings yield. So company will pay a percentage, let's say 50% of the earnings. So if the PE is going up, the earnings yield will be going down, the dividend yield will be compressing, going down as well. So I'm looking for stocks where there's potential for something to happen, some catalyst that will drive down the dividend yield, not because the dividend is cut, but because the share price goes up. And when that happens, it's the best feeling in the world. I get a huge sort of sense of euphoria. I would like it to happen to every stock in the portfolio. Realistically, it doesn't happen to every stock in the portfolio, but over time, I hope that each of the stocks in my portfolio has got the triggers to deliver that re-rating. If it becomes clear that I'm wrong, or if it becomes clear that it's already fully played out, then I can move on, and that's the trigger to sell.
Imperial Brands is something that you mentioned earlier on. That's the biggest holding in the trust at the moment. What is it that you like about that particular stock?
Yes, it's still quite contrarian to be talking about a tobacco stock. I'm sure listeners will have their own views about it. I think whether we like it or not, these stocks, they will exist in some form or other. I mean, if we want all these stocks to delist, and I'm talking about any stock with some wrinkle from an ESG perspective, if we force them all to delist, they'll go into the shadows. They'll be owned by private equity companies. They won't report publicly. They'll keep all the information they can as close to their chest as possible. I don't think that's in anyone's interest. So let's start with that point, that actually there's a slight understanding going on, an awakening going on, I would say, among investors, that actually it's fine to own stocks, defense stocks, let's say, or tobacco stocks. That actually, as long as you talk to management teams and ask them what are they doing to protect clients, employees, et cetera, et cetera. So that's the first point. There's a real kind of, I sense it now. It's a reinvigoration of stocks that have been tossed out because of ESG. So that's the first point to make. Second point to make is this really well-run company. The chief exec, we knew him when he was at Inchcape. And he did a great job there, which is a motor dealer. He moved up to Imperial Brands, which is a pretty big company, and it's a big sign of respect to him that he did make such a big move. He's done a great job. What he's done is focused on their core products. He's cut wasteful investment in products that just weren't working. And so he's driving up the cash flow that the company makes. And because he's doing that, it's a sort of 80-20 principle. I'm sure some of you have read, I remember some old books that I read, sort of management books that I read when I was back at university, and they always made sense to me that you focus on a few things and you do those things well. And that's what Imperial Brands are doing. So they're driving up cash flow. Now, what are they doing with the cash? Well, they are investing some of it in new opportunities, and they're having some success with some of these new products they're launching. Got quite good market shares in some of those names. So I think there's real evidence some of that's coming through. But the key thing here is that they are handing capital back. And it's not just in the form of dividends. They're doing some dividends. So they've got a 7% dividend yield, but they've also got a buyback of about the same, about 7%. So if you add up the dividends yield and the buyback yield, so divide the buybacks by the market cap, and you get to another 7% or so. So you've got about 14% or thereabouts coming through in cash back to you as a shareholder. And you don't have to be a genius to work out that if you sit there for X number of years, you've got the entire market cap back, which is quite exciting, really. It's back to the old margin of error, margin of safety sort of concept that Benjamin Graham came up with. It's sort of, well, it's sort of how you'd have to be pretty wrong for that not to be a winning investment. Yeah, we could still be wrong. It could be that all regulators all around the world decide to shut them down, in which case they won't be paying 14, 15% of their market cap out each year. But you don't have to hang around too long to get your whole investment back.
Yeah, no, I was in Korea last week, and certainly tobacco smoking seems alive and well there, and less vaping. I mean, vaping was going on too, but definitely evident. And I also, obviously, the trust is not just about these high-profile, major, large caps. There are some smaller companies in there as well, and including in your top 10 holdings. And I was just wondering if you could tell us a bit more about Galliford Try, which is only 390 million market cap.
Yes, it's a fascinating one, this one. So some of you will know about Vistry, which used to be Bovis Homes. So back in 2000, we were owners of the combined entities. So they used to own, Vistry used to own Galliford Try. They demerged it. Effectively, actually, it was the other way around. It was Galliford Try demerged Vistry, which went on to merge with Countryside, and we owned that initially, and then we sold out. They went fully buyback, funnily enough, actually, which we were against. We thought they should carry on paying some dividend, so we got out of that one once they moved fully to buyback, and they've had a few problems in the last few weeks, so we're quite glad we sold. Galliford Try, on the other hand, is a construction company, so it's pure construction. They've got net cash. So one of the things that happened was when they demerged, they got this dowry from Vistry, which meant that they went net cash. And you know what? When I look back on all the meetings I've had with the chief exec over the last 3 or 4 years since they demerged, that's been the big breakthrough. The fact that they had a net cash balance sheet meant that they could go into conversations with government agencies, because they do a lot on roads, they do a lot on hospitals and schools. They're on all these framework contracts with the government. They can go along to those conversations and they can say, look, you can rely on us. We're not one of these fly-by-night companies that you've never heard of that might go bust at any point. And there was one of those recently. ISG went bust, and they're picking up some of the pieces from that. This gives them enormous credibility with these huge contracts. And so that's been a big success. They're growing their order book. And I think what's really important is that they're able to win adjacent business. So instead of just being a pure construction company, they're growing more and more in value add services. So once they've built the building, they can offer services like fire safety and so on. And that gives them an increased margin. And what's really good about this is that we all know from our day-to-day lives how bad the UK's infrastructure is. Most of it is Victorian. Seeing that with National Grid, with the rollout of the electrification program that they're doing, but you're also seeing it in water, for example. Now, we all want to be able to swim in rivers and swim in the sea. I'm from Kent originally. I have to check the Surfers Against Sewage website when I'm down in Kent in the summer, because I don't want to be next to a sewage outlet. Now, Galliford Try are one of the biggest operators in water, so they've got roughly 90% of their revenues for any given year in the bag by January the 1st of that year. So it really is decent quality business, net cash balance sheet. It's now re-rating at last because we had to wait for a bit. First year or two of owning that stock was, it's painful. But of course, you get rewarded in the end if you've got that patience.
No, that sounds very interesting. And I could be going on all afternoon asking you about further companies in the portfolio. Thank you very much indeed, Thomas. That's been a really interesting insight into the UK equity market. And I just wanted to mention to people that if you want to find out more about the Aberdeen Equity Income Trust, it has its own it has its own page, part of the Aberdeen website. You can find out more on abrdn.com/AEI. And I think you can sign up there, Thomas, to regular bulletins from yourself as well on the equity market.
That's correct, yes.
Brilliant. Well, thank you very much for coming on the show this afternoon. I really appreciate it.
Yeah, great to speak, Stuart. And let's hope that all those fears about the UK domestic economy are misplaced. I think I'd finish just by saying, that actually valuations are that low that we're all feeling a bit jaded, aren't we, after the last few years? But we just keep hunting for those cheap stocks where there's potential for the valuations at some point to move up.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.